Hey guys, it's Chris Mancola with the Mancola Group over at West USA Realty. Just putting together our second weekly market update. The reason why we did two this week, I had explained earlier in the week, is because we had a lot going on this week. We had the Fed meeting in the middle of the week, and then today we had the jobs report come out. Why that's important is that's what the Fed was looking at. So they wanted to see how much unemployment we were going to have, and that was going to affect their policy moving forward. And we knew that unemployment looked like it was on the rise from the last report or two after some of the other information caught up. So I'm going to go ahead and share my screen here with you. And this is going to be exciting because we are going to see rates trend down from this point forward. Always going to be a little volatility in the market with the bond market and everything. But unless the Fed or the government does something crazy with printing a lot of funny money, we should be good to go. So here's where we're at. Um, just to kind of put this in context, the Fed's dual mandate is, maximum employment and price stability. Okay, that's their mandate. Now, what happened this week or in the past month with the past couple of months, actually, with the jobs report is interesting. I want you to hear this really quick before we go any further, and I'll kind of explain it as we go. All right. This is from Bloomberg. They're usually pretty good about this sort of stuff. So check this out.
Got to ask the immediate question, is the SOM rule in force at this moment?
It triggered. Yeah.
Wow.
Yeah.
There
So
we are.
that puts it up over its 0.5 percentage point threshold, noting that comes off of historical experience. That doesn't necessarily tell us where, we are right at this moment saying a recession. This has seen way too much momentum in the unemployment rate in recent months. I mean, 4.3%, right? This is not, so whether we are at that moment of a recession or not, this is your build into substantial weakening in the labor market. Right, like we have seen potential. All is not lost. We are, the bottom's not falling out. We should never panic. There are policy tools, there are levers, and again, I don't overread one data point, but this isn't one data point. So I think the case now for, hey, we're normalizing. We did need to slow things down some, probably, generally speaking. But now the question is, okay, so we've had enough slowing here. What levels this out? And that I think I don't have the answer for that.
Claudia,
That's a big one.
an economist of merit, Claudia Sam, by the name of Stanley Fisher.
Okay, guys. So the SOM rule, what is that? Well, basically, if we have a half a point unemployment move in a short period of time, like in a 3-month period on a moving average, 3-month moving average, a half a point jump in unemployment, that brings in what they call the SOM rule. Okay, triggers that, which sends alarm bells off to the market, the Fed, Wall Street, all that. That hey, we are headed into a recession. Okay, so some people are saying, not yet. This is nothing to get too crazy about, all that. But the reason why we want to bring this up is because the Fed watches this unemployment more than even inflation. Obviously, inflation, PCE is what they look at, does affect what they were trying to do. They were trying to slow down the inflation rate and try to get it down to that magical 2% that somebody told them about 30 years ago that they need to go by. And for them, unemployment, just so you realize, their point of a kind of normal unemployment rate is actually 5%. So today they're not even at 4.5, but because it's kind of taken this huge jump so quickly in this SOM rule context, alarm bells going off. Plus, we had the Fed meeting just before this came out, which of course the Fed is tracking all these numbers as they go, even though a lot of times they're looking in the rearview mirror. But and they even go on to say in that video I showed you, and a lot of other economists are saying this, you know, it's kind of crazy not to lower the Fed's fund rate now, which will affect the bond market and the trading that goes on there, the 10-year treasury, which of course will then affect mortgage rates. So the mortgage industry usually is ahead of what's going on here when they see things like jumps in unemployment and what the Fed is signaling, kind of their messaging, in other words, what they're saying in their meetings to the public. So they're ahead of this right now. So what I'm telling people is we are heading into a shift. So if you're thinking about making a move, if you're thinking about buying, if you're thinking about doing something or selling even, now would be the time to really start talking to your agent and your loan officer and whoever you're working with to get that going, because you want to be ahead of the curve. Because what's going to happen is right now you've got things like buy down rates, concessions that sellers are having to pay. And you may say, yeah, but Chris, I have to sell a house too to in order to buy. That's fine. But would you rather get the equity in the house you have now or the house you want to live in? Okay. In other words, once the demand shoots up as rates trend down over the next, rest of the year and into 2025. You have to, for some people, it may make more sense to wait a little bit longer, but I think in most cases, um, it probably wouldn't in from that standpoint. And again, nobody's got a crystal ball, but this is all the messaging, everything that we've been waiting for, everything that the Fed has been signaling is happening now. And I've been telling you this was coming, and here we are. So this would be the time to make it, because you want to get ahead of it before the other demand starts up. You want to get the house you want in the area you want with those great concessions. You can look at it as, may not get quite as much as I want for my house right now. I may have to pay concessions to a buyer in my house, but again, you're not only going to gain equity there later, but you're also going to be able to get those things too. Okay. And right now, with the way rates are, you probably want a buy down program that seller or builder pays for versus a lower price, unless you're paying all cash, obviously. But anyway, just some things to think about. We can always run those numbers with you with a loan officer or, with title and everything in if you're doing cash, and just kind of figure everything out for you there. But just some things to think about there. Um, so there's so much big news this week. I'm so excited, for the nerds of, us nerds who track all this stuff. So the 4-week moving average for initial claims of unemployment, we see that they have taken a big jump. This is the 4-week moving average. It's actually, a little bit higher than this week, but you can see that this has been ticking up if you look at these numbers down here as it reports. So mortgage rates reacted through the bond market, like we just said. Uh, 2 months, because they don't meet in August. The Fed doesn't meet in August, so they'll meet September 18th and 19th, like we told you about last week. And mortgage rates are down to the lowest levels in a year. Okay. So we should see a bounce, but we don't want this to only be a temporary bounce. We want this to be a consistent bounce. So, there's always going to be some volatility in the markets, but this is the trend. We should see this more and more of this. Now, the Fed is signaling that they're probably going to do, and everybody's pretty much saying that they, and even a lot of ex-Fed presidents and stuff are saying, why wait to lower the rate? But Jerome Powell is slow old, using a very old model. And that's just what he's doing. He doesn't want his legacy to be like, oh, I raised it too quickly, too soon. So anyway, since he's going to be out in about a year or two, I think it is. Um, but this is good news for everybody, right? And we see, 10-year Treasury tracks right in that, right in line. That's dropped off. That 10-year Treasury is usually what gives us our splits on this. So when we look at these splits, usually it's going to be 175 to 200 basis point difference. So, right now with it being around 3.8, 3 point, high threes or 3.8, just to use a round number there. We're seeing that, and along with the 2-year, which is a little bit more day to day and a little bit more volatile, that's way down 3.8. So that gives us where we are today with these are just the average across the country, average together. These are the rates for 30-year fix. Your 15, your FHA, VA, all of those. So I said so. MBS pricing are from the bond market significantly stronger so far today. This stronger upward movement is MBS should result in lower mortgage rates for today. So all good news. And what we want to keep in mind here is, as if those unemployment numbers keep ticking up and as inflation continues, the rate of inflation continues to go down. We all know that a lot of these old numbers from the inflation peaks that we had, definitely, you know, are baked into the cake now, and people are paying more for everything, including housing. But just what is happening now is important to where we're trending to. So again, do the opposite of what everybody else is going to do. You got people waiting right now because of the election. You got people waiting right now, not really sure what all this means. This is what it means. Okay. Um, and you know, the other thing is the signal that we're going into a recession. Every single recession that we've ever had, the Fed hikes lead to recession, right? Okay. And then as we go along with that, unemployment rate and recessions go together. And we also know that in every recession, we also see pricing goes up. Okay, so yeah, and as far as homes, because when you have a recession, rates drop and it's more affordable for people to buy a home. And for every 100 basis point or 1% in interest rate on a mortgage, we know that 5 million more people not that they're going to, but can afford to be brought back into the housing market. Okay. Um, a lot of people want to talk about, some similarities with 2008. And, we always have to get into that, but the real estate, right now the real estate market is really experiencing record low inventory. You gotta understand, from 2007 and it really started in 2005, but 2007 to 2011, we had an excess in building, but we also had the poor lending practices, the super high inventory, like 4 million homes for sale right now. You've got about 1.35, not even 80,000 a week, where back then you had, you know, uh, 250 to 400,000 homes coming on the market each week for this long sustained period of time. So you had this over inventory, poor lending practices, and it led to all these crashes happening. People, going into foreclosure, short sales, and everything. So we don't have that today, and people have more equity than they've ever had in their homes. The big difference is that extra inventory, but that extra inventory wasn't just from builders overbuilding, but it was people who, were selling their home but weren't buying a home ever again or for several years because they had to claim bankruptcy, short sale, foreclosure. So typically, you have 70 to 80% of people selling a home are going to also, and those are conservative numbers, but 70 to 80% of them are going to be buying properties also once they sell. First time home buyers come in, they make up a little over, right now, 30%, a little over 30% of the entire home market. So you kind of take all those numbers and put them in context, and you see that we're nowhere quite near what people, sky is falling people, clickbait people on YouTube want to tell you, or in the news. We've talked about this before. If you look back in the news at some of the stuff that they've said over the past even decade, it's crazy. But we have really a total of 80 years of this data. So we know that, really there's only been that really one window of time where we had this giant housing crash. And just because prices may be flattening out right now in certain areas because of this 2-year higher interest rate thing going on in the economy, where they've kind of flattened out, they're still at all-time highs. And we still have low inventory. So, it's not like anything crazy's happened. Just because there might be a slight price adjustment or correction doesn't mean we're having a crash in certain areas of the country. Okay. So anyways, just to kind of put that all into context, and make it, so that we can tell you that. And let's see, what else did I want to get you to? Okay. So if we look at inventory right now in the Phoenix area, it's a little over 17,000. Um, recession means falling interest rates, which I've already talked about. Here's our current numbers in the Phoenix greater Phoenix area. You've got 108 days closed on market. So obviously things are much slower than they would normally be. Uh, Ironically, we have 2.63 months supply off of that. And active is down a little bit, pending is down a little bit, and closed units is down a little bit. And so if you look at the absorption rate, definitely should normally be a little higher than that. For us, should be usually in the 40s is more normal. You got your average list price here at 742, average sales price 534. That's due to obviously the lower price ranges with doing most of the inventory. So you've got everything up to, especially up to that 600,000 mark. That makes up over half of all the inventory on the MLS. And then you have from there 14%, and then it's just kind of little bit here and there on the higher price points in the luxury market. So when we look at the stressed sales, short sales, lender REOs, they're down, and you look at the actual numbers of them, out of that 17,000 currently for sale, you really don't have much at all in the way of distressed housing for the greater Phoenix area. So again, nothing crazy there. The average, Crawford did this thing where they basically took back to 2001 to now. And Crawford, they're the people who give us our Crawford Market Index. They kind of are the gurus. I just thought this was some interesting information for you. They did a thing where they took home prices from 2001 to now, and they looked at adjusted for inflation, what that would be. Now, if you just looked at the nominal number, it would be an increase between then and now of 202%. Okay. But in real terms, adjusted for inflation, the US dollar is actually worth a little bit less right now. The increase is 69%. So this suggests, that while prices have risen, the real growth is less dramatic from that standpoint. When you take the adjusted inflation and the power of the dollar right now. So the best bargains were between 2008, going back during that time, uh, between 2008 to 2015. Okay, for the greater Phoenix area. Okay, for the greater Phoenix area. Um, so, prices are still, below the peak levels of the end of May, um, or I'm sorry, yeah, into May of 2022. Okay, to levels late 2006 and similar 2006 and the end of 2021. So again, all adjusted for inflation, but the kind of the idea is that you had these significant booms between 2004 to 2006 and 2020 to 2022, uh, with current conditions in the market reflecting a correction from the recent peak. Okay, so that's all straight from Cromford. Market conditions nationally, the median sales price has hit a record high nationally. But sales volumes remain low due to high mortgage rates and affordability issues. But again, we're getting into a shift right now. So we're in that beginning stage of another shift in the market, guys. Just keep that in mind when you're making your decisions. Let's talk about that. I'd love to be able to kind of go through your numbers, your situation, see if anything makes sense. Right now, even people are refinancing who maybe bought in the last year or two. Reach out to us. We can put you in contact with the right people for that. Um, for investments right now, some people are doing is they're even going into, and I've told people about this in the past, but you can go into new home communities that's going to have, 100, 200, 300 homes for sale, eventually that they're going to go through or more. And, go in the outlying areas, buy a couple of brand new homes and rent them out, especially in these spec home areas. But they're going to be building. So as they build, usually they all have a different model, but usually, it's every few homes, they'll go up $1,000 right now. It's kind of typical. Anywhere from $1,000 to $5,000. And it seems like that's around per week. Again, depending on the area of the valley. But they're going in outlying areas. Like, for instance, we had somebody recently who looked at, two homes in Coolidge for, a little over 300,000 in the low threes, because they had, 600,000 to work with, rather than buying one property for 600,000. Or there are multifamily properties out there, duplexes, triplexes, fourplexes. So those are all things that we can definitely, kind of look at and help you with. Um, but the mortgage rates right now, again, I always mention this, you can get lower rates right now. I repeat, you can get lower rates right now than what you're seeing on the news and what we just talked about. And the way you do that is you have the seller or the builders are offering this all day long. I'm seeing rates as low as 4.5 for a rate buy down. Okay. So yeah, you can get that today. Okay. And the seller or builder's paying for it. The great thing is that money sits in an escrow account. So later on, if you ever did want to refinance to lower the rate even more down the road, that money just sits in that escrow account, and you're not only not having to do any out of pocket costs, but no cost at all to do that additional refinance. Okay. So, that's something that's really big right now. um, this month we had, before I get more into the market news, whoops, hang on one second here. I'm going to actually share my screen here again with you. Okay. Um, Let me see if I can find this. Okay. Yeah. So I just wanted to show you this real quick. You hear a lot of junk in the news about this, and there's a lot of misinformation about this right here. New rule: Arizona buyers must sign contract before touring homes for sale. Now, if you're going to an open house, okay, you're probably going to need to sign in. That's pretty standard. So they can track for the homeowner who's come in and everything, and kind of follow up with people and all that. But if you're coming to an open house, you're not going to have to sign any forms. But be aware that this is a new DOJ, Department of Justice rule, that first of all, we can't put, like we used to do, compensation to the buyer's agent in the MLS anymore. Okay. Can't put it in there anymore. Number two, if you're going to tour homes, this starts, this actually started yesterday. And a lot of this we've been doing anyway since like 2012, since we got in the business, where we have to have some sort of a buyer broker agreement. In other words, you hire us to be your agent and represent you to tour homes. We can do that as little as one day for a period of time, whether it be one day, up to 3 months, because by the time you find a home, it may be a couple of weeks. You go under contract. If you got a home loan, depending on the home loan, it could take 3 weeks or more if you're doing a construction loan or something like that. So depending on your situation would be the thing that makes sense. But we always do a buyer consult up front. We get the buyer broker hiring documents up front, whether you're buying and or selling a property. And we've always done that. But for a lot of agents that weren't doing that, it was kind of this makes it more professional. This kind of brings in a higher level of service, because, it's kind of like you go to an attorney and you kind of, you ever see the thing on TV where they say, here's $1, you have to, have a relationship, an agency relationship, in other words, and it's with our brokerage, West USA Realty. We're Mincola Group of West USA Realty. That's our broker, or whatever broker it is that you're dealing with. So keep in mind on this that to tour any homes, private showings, to work with a buyer's agent. Just like when you had to have a hiring document to sell your property with an agent working that you're hiring, um, this is what you're going to have to do now. It could just be as simple as a what's called a touring document, basically, of homes. For, again, for the day, the weekend, whatever, the next couple of weeks, whatever it is, or a full-on exclusive buyer agent. We call it a co-broke, but it's basically you hiring us, and that document um, allows us to not only help you get into properties, but write offers on your behalf. So it's now a lot of talk out there about, oh, there's no more buyer agent commission. That's not true. But in the past, the seller or the seller's agent could always offer whatever they want. Now it's the same thing, except it's a little bit more explicit in the um, it's not quite the same, but it's a little bit more explicit in the documents where when you're hiring the buyer's agent, that if a property does not, and it's always been this way, but if a property does not offer a commission to us, then the buyer has to pay us. Okay. Um, and so in the past, we've kind of gone through that with people in our buyer consultation. So I think there may be some gimmicks out there. There's going to be some sellers that are going to try and do it without paying people for their job that they do and their work. I don't think that's going to go very well long term. I think you're going to have maybe 10, 20, possibly up to 30% of people trying to do that on the get-go. But I think most buyers, especially first-time home buyers, people moving in from out of town and stuff, they want an agent. They want to be represented. They want to really know what's going on in the market. They want the inside scoop on things that you just can't get off Zillow and all this other nonsense that's out there. So um, there's just a lot of gimmicks. So be careful what it is you're signing and who you're signing with. In other words, reach out to us so we can kind of go through the details with you. But when you hear this thing about, well, sellers don't have, I think even the president said this recently, you don't have to pay a buyer's agent anymore. Well, you never did, but you know, like over 90% of people have an agent. So that's going to really limit your buyer pool because a lot of people want to be represented. And I would always recommend, not just because that's part of what I do. We list homes for sale too, obviously, but I would never recommend somebody buy a home without being represented. It's like going into a courtroom not being represented. And even if you've bought and sold homes, there's always changes to laws. Part of the reason why, number one, when you have for sale by owner, for instance, I don't think people realize that on average, uh, 20 to 30, they get 20 to 30% less when they sell their home. Also, right around half of the people who do for sale by owner, they actually end up in some form of arbitration, litigation, whatever you want to call it, because maybe things weren't disclosed properly. Maybe there was some sort of a thing in a contract somebody didn't really understand or get taken care of properly or disclose or whatever. And, when you go straight, as a buyer, when you go straight to the seller or straight even to a builder, you really leave yourself wide open, just like going into a courtroom unrepresented, to a lot of problems. As a matter of fact, not only do for sale by owners get about 20 to 30% less, for their sale, we see these, and they're not all for sale by owner, but a lot of them are in the MLS on the back end. We can see non-MLS sale. And, when we see that, or when an appraiser sees that, we can't even really use that for a true comparable sale for an appraisal, okay, or a real when we try to put a value on a property. So there's a lot to this. You definitely want to work with somebody who's going to represent you well, that's experienced and knows what they're doing. But this idea that there's not going to be any commissions or whatever, people are going to work for free, or I don't know what, or, it's wonderful to be not, not to be represented. It is, all a bunch of nonsense. Again, misinformation that you get in the media about a lot of these things. So, anyways, I just thought I would throw that in there because that's happening this week and this month. That's all starting too. So be aware of that. So for right now, with the current market trend, just like last week, we're in a balanced market. This is the Cromford Market Index. That Cromford Market Index basically tells us where we are in the market as far as supply and demand. And as of right now, this has us at 99.6 with the latest reading. Anything under 90 is a buyer's market. Anything over 110 is a seller's market. When you look at demand and supply, they're almost the same. That's why at 100 would be dead center, but that's off just a hair from that. So we're actually, in reality, a little bit, starting to trend. We're in balance, but starting to trend towards almost a buyer's market in the greater Phoenix area. Now, demand, reading at 100, which would be dead center on the index, we are at, 73.9. So we're about, 27 points too low on demand. Again, higher interest rates, but now hopefully we'll see this bounce. And then we've got supply, which is about 26 points too low. So, that's where we are in supply and demand, which are always going to dictate the market. And again, nationally and even locally, we still are low on our supply. Okay. Although nationally, the numbers have gone up, it's a little bit more of a balanced market than it was nationally, a seller's market. Now, a lot of the inventory that's coming out, though, I figure out that it's actually coming out of Texas and Florida. But anyways, that's kind of where we are nationally and locally on that. Now, the national median sales price, here's something that I thought was really interesting. Check this out. So the national, when we're thinking about, oh, prices have gone up, but are they going down now? Where are we really in reality within the context of a normal market? So this is just like a normal balanced market, guys. Things just take longer to sell in that. A normal balanced market traditionally was thought to be 4, maybe even up to 5 months to 6 or 7 months. I think the internet has sped that up a little bit, with people being able to get online and do, things, DocuSign and things like that, even as they're traveling. But that was always the traditional, for the Phoenix area. I think it's more, around 3, is a normal month supply. That means if everything's sold and nothing else come in the market, that's how long it would take to sell everything that's on the market that's available. Okay, for the choices and inventory on sale. So the national median sales price, if we go all the way back to 2021, again, looking at that 2021 to now, this is from Cromford also. The national median sales price, they took it at 4%, which is kind of a normal national average. Would with an annual appreciation of 4%, would put them during that period of time from 169,000 to 418,000 today. And in reality, it's at 420,000. So really not that far off from 2001 to now. If you took the normal appreciation and then with all these, with the market crash, and then, with prices going up over like a whole decade, and with the anomaly that we had, in the 2020 through the beginning of 2022. So when we look at the Phoenix area, it's a little different because we're always a little bit more, we have a little bit more in sales, a little bit more aggressive. That's why a lot of investors come here. But from 2001 to now, if you take what would be kind of our average, which is usually about a 5% growth rate in prices each year. And they did this with properties under 25,000 square feet to take it as a bulk number. and non-luxury type properties. Um, it went from 2001, it went from $130,000. Um, it would a 5% appreciation would have been 399,000. Again, that's what that annual 5% normal rate, okay? From 2021 to 2024. But today it's actually, median's always lower than average. So median is actually right now at 430,000. Okay. 430,000. So a little bit higher than the national average as usual. But I just thought that that was an interesting thing they put out. They put all kinds of stuff, so I just figured that was interesting. Let's talk about that. Existing home sales continue to slide a little bit in Arizona and nationwide. Um, you see, existing home sales slipped 5.4% to an annualized 3.89 million, the lowest level since December of 2023, after falling 0.7% in May, according to the National Association of Realtors. Um, at the same time, the median sales price jumped to a record high of 426,900 nationwide, according to the National Association of Realtors. This is the second straight month that reached an all-time high and the 12th consecutive month, a year-over-year price gains. And again, this has to do with lower pricing. And it's kind of funny, I talked to different realtors online or whatever throughout the country, and that we do some business with, and it's like, people on the East Coast right now, a lot of them are talking about multiple offers on properties, things going really quick, people, doing lease backs, kind of some of the stuff we saw 2-3 years ago. So anyway, it's all within context. Every area for real estate is really local, hyper local. um, the 5 markets with the biggest year-over-year increases, um, Burlington, Vermont, Phoenix, Arizona, San Antonio, Texas, Richmond, Virginia, and Miami, Florida. Phoenix, year over year, has a 25% change. So, with new listings, this is for new listings, new inventory. So that, even though we've gotten that new inventory, our prices have held pretty stable, but it has slowed down the market along with those interest rates, obviously. This makes sense that it would. Um, the sales per year are definitely down though, and I think this 2-year period of these higher rates, have just really, and then with the overall economy and the high inflation everybody's having to pay, even though the rate decreased and all that, people are really feeling the crunch just to go to the store or anything. A lot of people not going on vacations, all kinds of stuff. People are having to adjust. That they would normally not have any trouble with. So in 2024 for this year, right now, the sales as of let's see, this was as of July 5th, from the Cromford and MLS, we had 70,000, a little over 70,000 sales, which was way below last year at the same time. We were at, let's see, same month, for, let's see, that was taking readings in June, put us at about 74,500 sales. So quite a big difference. Okay. Um, so yeah, our sales are definitely down, guys. But I think again, we're in this beginning of this shift. As interest rates drop, I think we're going to see people, again, we're already seeing refis, we're already seeing more, mortgage applications have gone up over the last month or two. Um, and sales per year, if you had to go back and look at where we are right now and where that kind of joins up, would be 2009. So the sales are definitely lower than they normally would be. Now, on the Crawford Market Index, we talked about the overall index and where that is. The areas of the valley that are in a seller's market, but these top 4 are going down, is Chandler, Fountain Hills, Avondale, and Phoenix. Those are all in seller's market, but all decreasing on the Crawford Market Index. Scottsdale is in a seller's market, barely at 127. Same with Mesa, 127, Glendale, 122, Gilbert at 114, just over that 110 mark. So kind of in the seller's market. And then we have Tempe that's at 111. We really ought to count that. So Peoria is at 105. That's a balanced market. We've got Paradise Valley. That's in a balanced market. And then Goodyear, Cave Creek, Surprise, Queen Creek, Maricopa City, and Buckeye. Those are all in buyers markets. And looking at the contract ratio map, which is a little bit more accurate than even the Cromford Market Index, because it's kind of now numbers. Um, you know, we are looking at, more and more, not hot areas, but more balanced and warm and even cold areas, or even colder in some spots of the valley. So right now, it looks like South Phoenix Lavine area is still pretty busy, along with Tolleson, Goodyear, Glendale, and that's going to be it for this week, guys. If you have any other questions at all, feel free to reach out to me. I hope that helps. Get ahead of the market. Let's talk about anything you're thinking about right now, whether it's real estate, mortgage related. Let's talk about that. We can definitely get into the details with you. Talk to you guys soon.